Are you curious about how one day trader made an astonishing $18 million in profits? Look no further than this video, where we'll take a deep dive into his trading strategy and the specific indicator that led to his incredible success. We'll uncover the secrets behind this trader's approach and explore how you can apply these insights to your own investment decisions. This story is a testament to the power of having a solid trading plan and using the right tools to execute it. Join us as we reveal the indicator that made him millions and learn valuable lessons that can help you achieve your own financial goals. Don't miss out on this opportunity to learn from a true trading success story. John Carter is a renowned trader and the founder of Simpler Trading, a company that provides education and resources for traders. He's also the author of several trading books, including Mastering the Trade and The Squeeze. One of the indicators that John Carter created and uses in his own trading strategy is called the Squeeze Momentum Indicator. This indicator is designed to help traders identify when a market is experiencing low volatility and is likely to experience a breakout in the near future. The Squeeze Momentum Indicator is a technical analysis tool that helps traders identify potential breakout opportunities in the market. It works by combining two different indicators, Bollinger Bands and Keltner channels. Bollinger Bands are used to measure the volatility of the market. They consist of two lines that are plotted two standard deviations away from a simple moving average. When the price of the stock moves outside of these bands, it's considered a potential trading opportunity. Keltner channels are similar to Bollinger Bands, but use a different calculation to plot the upper and lower limits of a stock's volatility. They are plotted using a moving average and the average true range of the market. The Squeeze Momentum Indicator plots both Bollinger Bands and Keltner channels on the same chart. When the Bollinger Bands contract and move inside the Keltner channels, it's referred to as a squeeze. This indicates that the market is experiencing low volatility and that a breakout may be imminent. The Squeeze Momentum Indicator also includes a histogram that measures the momentum of the market. When the histogram is positive, it indicates that the market is in an uptrend. And when it's negative, it indicates a downtrend. Traders can use the Squeeze Momentum Indicator to identify potential trading opportunities. When the Bollinger Bands squeeze inside the Keltner channels and the histogram is positive, it could indicate a potential bullish breakout. Conversely, when the Bollinger Bands squeeze inside the Keltner channels and the histogram is negative, it could indicate a potential bearish breakout. Overall, the Squeeze Momentum Indicator is a powerful tool for traders looking to identify potential breakout opportunities in the market. By combining the indicator with other technical and fundamental analysis, traders can make more informed trading decisions and potentially increase their profits. Now that you understand how this interesting indicator works, I am going to show you some ways in which we can take trades based on the indicator. First, we can see that the market is sideways when the indicator shows us red dots. Then the next thing we can expect is a breakout of the zone and take a trade to catch the trend. In this case of Bitcoin with a 4-hour time frame, we see that the color of the indicator changes from red to green. And we are with a positive histogram. This means that we will take a long trade, and we could set our stop loss at the most recent swing low. And we would exit the trade when the squeeze momentum shows us trend weakness, that is, when the color of the histogram changes. And we got a risk-reward ratio of 1 to 3.38. Incredible! The bad thing about this strategy is that it gives you many false entries, as we see in the graph in some previous candles. But with a good technical analysis, you can greatly improve this breakout strategy, just as we have applied it in this trade. We can also apply this indicator when we have a throwback or a pullback. Now we are in euro dollar with a time frame of 5 minutes. And we can see an uptrend on the chart. As we see, I have drawn the last swing high, and the price has touched the same area and bounced. Then we would take a trade when the squeeze momentum indicator confirms the trade, that is, it shows strength in the trend again. We take a long trade, set the stop loss at the nearest swing low, and exit the trade when the indicator turns from positive to negative. And we see that it was a winning trade with a risk-reward ratio of 1 to 2.73. If you've made it this far, don't forget to subscribe and like the video to show your support for the channel. Another way to trade is divergences with squeeze momentum. A divergence in trading refers to a situation where the price of an asset moves in a different direction than the indicator being used to analyze it. Now we are with SP 500 mini futures with a 1-minute time frame. And what we're going to do is draw the divergence on the chart. And we will take the trade when the last bullish microtrend is broken along with the indicator that shows us weakness. We set our stop loss at the last swing high. And our take profit will be a risk-reward ratio of 1 to 2. We see that it was a winning trade. Now that you understand how the indicator can be traded, I am going to show you a strategy in which you can put these 3 strategies together as knowledge and apply it. For these strategies that I have shown you, we can take short trades as well. We would only have to reverse the rules. First, we are going to add our indicator called TTM squeeze created by Drekken and leave it as default. Then we add an exponential moving average, and in inputs we change its period to 200. Perfect. Now that we have everything we need for the strategy, let's see how it works. First, to take short trades, the price must be below the EMA 200. Second, we must analyze if we are fulfilling some of the previous strategies that we have seen. In this case, on the DXY chart, or also known as the dollar currency index with a 3-minute time frame, we see that a divergence is taking place. So we will take a trade when the indicator is showing us price weakness. And the interesting thing is that we have a pullback at the same time. We are going to take a short trade. We set the stop loss at the nearest swing high. And our take profit will be with a risk-reward ratio of 1 to 2. We see that it was a winning trade. Now let's see another example. To take trades in long first, the price must be above the EMA 200. Second, we must analyze if we are fulfilling some of the previous strategies that we have seen. In this case, we are in Amazon with a time frame of 3 minutes. We see a divergence and a pullback happening at the same time. Then we will take a trade when the indicator is showing us price weakness. We are going to take a long trade. We set the stop loss at the closest swing low. And our take profit will be with a risk-reward ratio of 1 to 2. We see that it was a winning trade. We hope you found this video informative and that you learned something new. Remember, trading can be risky, so it's important to always do your own research and consult with a financial advisor before making any investment decisions. Don't forget to like and subscribe to our channel for more valuable insights and strategies to help you improve your trading skills. Thank you for watching, and we'll see you in the next video.